What's going on, guys? Welcome back to another episode of the Real Estate Investing Q&A show. I moved to the couch for this one. I was getting bored of sitting at my desk. This is way more comfortable. We're probably going to be moving office next week, so figured I would do it here. Just a nice change of pace. Update on what's been going on. Office is almost done. Furniture's been picked out. Getting delivered next week, I hope. Cross your fingers. Let's see if it actually happens. But super pumped to be in. Columbus deal, 360 units, going to be closing next week. Just wrapping up investors and documents today, early next week, getting wires and closing. So that should be fun. Really looking forward to that. That's going to be a great deal. Monday and Tuesday next week, I'm going to be in Jacksonville. We got due diligence on a 92 unit that we're going to be doing. So I'm going to be down there Monday and Tuesday. Hopefully get some good stuff for you guys to take a look at, see, get a sneak peek into what we do, how we do it, and all that fun stuff. Other than that, what else is going on? We're still selling one of our deals in Jacksonville. They just did their physical on-site inspections. Now they're going through all the documents. Got some good feedback. They seemed to like the property. They thought it was in very good condition. That's because our manager in Jacksonville is phenomenal. Lisa, if you're watching this, thank you. I don't know why you would be, but if you are, you're the best. What else is going on? That's all the big stuff. I've started trying to read. I've been doing 10 pages a day, just trying to implement that. Something I've always tried to do, but I've never been a big reader, so I'm forcing myself every weekday to read 10 pages. Just been posting about it on my Instagram story every day. But that's really it. Before we dive into the questions, if you happen to be watching, you're not already subscribed, that would be awesome. If you want to like this video too, that would also be awesome. And if you're not following me on social media, Instagram, LinkedIn, Facebook, and I'm just starting TikTok, just search for me, Chris Grenzig. You should find it. And with that being said, going to dive right into the questions. I'm going to go 4 this week because I found 4 that I like, all from Instagram. First one. I've been doing my homework steadily for the past few months and want to get into my first deal. Area I'm looking at is Columbus, Ohio. Great market. But I'm having trouble figuring out financing. In your opinion, what's the best way to get financing if you don't have enough for the 10 to 20% down? I've been looking to try to get sellers to put down the down payment and pay them back at a fixed interest rate over time, but would love your opinion. I am not a proponent or advocate of over-leveraging deals. And usually what that means is often creative strategies to get involved. So I am more of an advocate of if you can't afford 10 to 20%, you've got to do something else to save up that money. I don't think there's a shortcut around it, because the problem with that is let's say you got 80% of the deal as a mortgage and the last 20% was the current owner. What's your incentive to make sure that deal performs well, and how much is that actually going to pay you? If you don't have enough to save up for a 20% down payment, you probably aren't buying the biggest deal in the world. So it probably doesn't cash flow large dollar amounts. You may be making $100, $200, $300, $500 a month. That's only $6,000. But that's just with the mortgage. So now if you're also going to pay someone a fixed interest on that other 20%, that $500 a month is going to go down to $300 a month or $200 a month. That's not a lot of money. And if all of a sudden you're making $200 a month when the property is 95% occupied and it goes to 85, and now you're making nothing, well, you've got no money invested, you're over-levered, you're making no money, so you're going to have no incentive to work, and it's just a downward spiral. The only thing you have going against you is a loan. And if it's a non-recourse loan, you can just basically hand back the keys, say, thanks a lot, but no thanks, here's the property, and that's that. So I don't like over-leveraging deals. So if you don't have the money for a down payment on a property, you need to look at yourself and your income and expenses on a personal level to save up for that money. So it either means you've got to save up for a couple years to get that down payment, start building rentals slowly. It means you've got to audit your expenses and find out where you're spending money you don't need to spend. or you've got to look at other ways to generate additional income to get your top line higher. So it's a couple things. It's getting your top line higher. It's getting your expenses lowered. Both of those result in more money in your pocket. And you've also got to look at, okay, maybe this is just going to take me longer to build up over time. So I don't like finding creative strategies to buy properties with little money because I think you're over leveraging, and as soon as something goes wrong, it just makes it worse. The more you leverage a deal with debt, it boosts your returns on the high end and the low end. So if you get something all cash and on a cap rate at 6%, so it pays you 6% a year, you borrow money at 4%, on the 20% you make 6%, on the rest you borrowed, you make the delta between the 4 and the 6. And that 2% delta between 4 and 6 gets added onto your down payment. So instead of just making 6% on 20%, you make 6% on 20% plus 2% on 80%. And that's why you see 6 caps make 8, 9, 10% cash flow. If all of a sudden on that 80%, that cap rate drops to 3.5%, you now owe money every month out of pocket. If it drops to 4% every month, you're breaking even. You're making 4% on your 20%. That's it. So if you dip down below, you have to come out of your percentage to pay the bank because that gets paid first. They're going to foreclose on you. The more you leverage, the higher that income is going to go as the property does well, but the quicker you're going to start losing money as that property does poorly. So that's why I don't like people over leveraging properties. There's plenty of people that do it. There's better people to ask that question, is really what I would say. I don't encourage you to over leverage a property. Next question. If I'm just starting out and I can't swing a multifamily deal, either no availability in the market or it's too high of a price for me, would you think it's a bad idea to buy a townhome single family to rent out in the meantime if it cash flow is pretty good, say $200 to $300 over mortgage a month? Part of me thinks it's a good idea because even if I can get it and hold it for a year or two, whatever the mortgage they pay down and any appreciation the property gets is all good for me. And if I want to fund another deal, I could either sell it or pull some equity out of it if I did a pretty good down payment. The other part of me thinks it's a bad idea in case a really good option pops up half a year from now, but I would already have bought this place, so now I won't have the capital to quickly close on this new hypothetical deal. That's basically the question is, should I buy what I have now or wait in case a better property becomes available? If you have limited resources, if you wait for a better deal, it may not come. So you're always playing a balance between, is this deal good enough or is it not? For me, once you decide something, you just have to stick with it and you can't play the what if game. There's plenty of deals that we pass on that end up doing phenomenal, and there's plenty of deals that we close on that don't do as well as we thought. Not plenty, some deals, luckily. So you can't really play the what if game. If a deal comes along that makes the returns you want and it's a deal you're happy with, I'm more inclined to say take the deal down because it's something you have and it's something you think will make you money. Forgetting the possibility of that deal or a better one even coming to your plate, it may not. If the market continues to go up and up and up, it may get more sparse and sparse of what you're thinking about. Not only that, it's still an investment, so it may not even do as well as you think. So I'm more inclined to say figure out what type of deal you want. And it can be more than one. It could be 3 types of properties. You know, when I talk to brokers, I tell them we have 2 types of properties, but we'll take anything in the middle. So I'll give, the highly distressed vacant deal on one end, and I'll give the light to medium value add on the other and say, hey, we'll also take anything in between. So instead of a vacant deal, it could be 60% occupied, for example. You can have more than one opportunity available to you. Doesn't mean you have to stick to one. But once you have that criteria, if you find a deal that fits it, you like it, and it hits the returns you want to do, and you have the resources available, take it, in my opinion. Don't try and wait for something that may or may not happen, that may or may not be better. So I would not wait. If you have a deal that does well, take it down. But if you're holding out because you think you can get a bigger deal or a different type of deal instead of taking down that one, and it's more important to you to get into that. So for in this example, if you're talking single family to multi, if you really want to get into the multifamily space, different story. If you want to hold out for a certain type of asset, even though a good deal comes along that's single family, different story. But if it's one or the other, you're not really high or low on both of them, then I think you take the good deal that comes across your desk that you like. Next question. I have 3 single-family houses. One I was going to list for sale next week and could make $80K if I sell it, or I could rent and cash flow $600 a month, which isn't much unless I buy more single-family. Right now, I cash flow $2,600 a month on the rentals. I don't know whether to sell all my single-family houses, and that way I can have some cash in hand and plan to find a small multifamily deal to start, or if I should keep buying single-family houses since I'm really good at finding those since I'm a realtor and find them all the time, and they're easier financing on them. For multifamily, I've tried to get financing, and they want me to have a net worth equal to the loan amount and stuff like that, or maybe I need to keep searching for different lenders. So 2 questions here. One is, should I sell my single families to go buy one multifamily? And the other one is a little bit about multifamily lending. Quickly on the lending, it is a little bit different. So talk to a bunch of different lenders and find out what loans you qualify for. I don't know all the different qualifications out there for all the different products, so it's tough for me to comment on. I'm not a lender. I can speak to the loans that we get as a company, but I can't really speak to, personal finances on a net worth and stuff for, sub-$1 million loans or even $3 million loans. So I would encourage you to find 2 to 5 different types of lenders. So that's mortgage brokers, bankers, credit unions, private lenders, and find out what their requirements are. And if you can't do it, you can't do it. You've got to either stick with what you're doing or find a partner that can help you out, a balance sheet partner, or just a partner that can get your balance sheet up. So on that side, not your best resource. Talk to people that are doing deals in your area that can look at your specific situation and tell you what's going on. In terms of should you sell all your single-family properties and buy a multifamily property, or sell your assets to buy one asset, I don't want to go too absolute on this, but I'm hesitant to say that's a good idea because I think there's something said for diversity. For example, if you have a roof that goes out on one of your 5 properties, it's 1/5. If you have a roof that goes out on your multifamily, it's everything. So, yes, multifamily is great because you get economies of scale, but if you have a problem that affects the whole property, it also affects your whole portfolio. So I am hesitant to say sell everything to buy one property, but I also get trying to scale up again. So if it's important for you to get into the multifamily space, which a lot of people really want to do, I don't think it's a bad idea because I think it's very similar. You still get diversity of multiple units. You're not reliant on one single property. It's not like you're selling 5 single families to buy one more expensive single family. That I would never recommend. So yes and no. The reason I'm more hesitant to say no in this specific scenario is he seems to have good deal flow and a good understanding of these types of assets. I think my advice in this specific scenario would be to hold out a little bit longer, see if you can get a couple more properties under your belt, and then look to take down a multifamily and keep 1 or 2 of the single family on the side so you have both going for you. So instead of putting 100% of your resources towards one multifamily property by selling your single family, in a few years, I think you can divert 80% of your resources to that one, and you've still got 20% working for you on the single family side. So you're not putting all your eggs in that one basket. I think too many people are a little quick to just scale up from one thing to another and put all their eggs into one. I think there's something to be said for continuing to build a little bit longer than you need and then diverting most of your resources, not all of your resources, into that one asset. So waiting that little bit longer. So instead of having 5 single-family homes and selling them and getting 1 multifamily, wait until you get 8 single-family homes and sell 6 and then go buy 1 multifamily. So you still have those 2 on the side. They're kind of plug and play, and you can figure out the multifamily while you still have the single-family stuff going. That would be my advice. The last question. Sorry, the screen went dark. I don't want to lose it. There we go. Still recording? Still recording. Okay. How big of a role does cap rate play in your decision to go after a property? What are some of the other big factors you'll look at? Another thing, what cap rate would you typically want to see in a lower multifamily home, maybe a duplex, triplex, or quad? Okay, 2 questions. What do we look for in cap rates in properties? And the other question is, what are typical cap rates for a type of property? I'm going to tackle that second part first. So a cap rate is what a commercial property would make all cash if you bought it. So if you bought a property for $200,000 and it was a 10 cap, you would make $20,000 without a mortgage. The way you back into it is if you made $20,000 and it was a 10 cap, you take $20,000 divided by 0.1 and you get $200,000. It's the same thing if it's, $20,000, $200,000, $150,000, and whatever the cap rate is. Cap rates are both by asset and by location. So you're not going to find the same cap rate if you took a property in the middle of nowhere, Kentucky, let's say. Literally middle of nowhere, rural area. You just drop the property there. That property is going to sell for a much higher cap rate than if you dropped it in the middle of Manhattan. The reason being, there's way more demand for Manhattan than the middle of Kentucky. So it's 1 based on location and 2 based on asset. A brand new 2019 built property versus a 1950s property is never going to sell for the same cap rate, or probably is not. They could be close depending upon the level of renovation, but most likely not going to be the same. So cap rate is very subjective. It's also subjective too on what you can do with it. If it's a stable property versus a value add property, and it's the same exact thing, same location, same property, vintage style and everything, but one is fully renovated and one is not renovated, they're going to sell for 2 very different cap rates as well. A value add property is going to be lower because I can put money into it and raise the cap rate on my operations. So if I have a $200,000 NOI, net operating income, and I can raise it to just say $1 million, just to be extreme, my cap rate on that $1 million in 3-5 years is going to go up into, let's say it was a 5 cap, could be 7, 8, 9, 10%, whatever it may be. It's a lot more because it went from 200 to $1 million. But be that as it may, that's how that works. So it all depends on a lot of different factors. There's not one concrete answer. You've got to do your market research, your asset research. The other thing too, right, from asset class to asset class, it changes from multifamily to office to retail to mobile home parks to, did I say office? To office. They all change based on the risk associated with the property or the asset class. So cap rates are very subjective by asset, age, style, location, vintage, renovation level, value left, et cetera, et cetera. So all that stuff matters. Also, future performance of a market. If a market is stagnant versus a market that's growing 10% population a year, 2 very different cap rates. So all that stuff matters. I forget the first part of the question. Oh, what do we look for in cap rates? We are less concerned about cap rates on properties when we buy it. The reason being, it depends upon how much value is there. We've bought a couple properties that are completely vacant, and obviously there's no income. There's expenses, probably, unless they're just not doing anything, and their NOI is 0 or could be negative. What's the cap rate on that? It's 0 or negative. So it sounds crazy, but there's so much value on it. In the future, we can get the NOI to a level that the cap rate is at what we want to sell at or higher, because that's where you make your money, is if you can operate at a level that's higher than where you want to sell on a cap rate, you make the delta below, and that's how you make a profit. So if we can get the operational cap rate to a certain level, we know we can make money. So we're less concerned about the cap rate going in, but it depends on the value. If you're selling me a stable property at a 3 cap and there's nothing I can do to increase the NOI except just if the market increases, that's no value to me and it's overpriced. Conversely, if I can quadruple the NOI and you're going to sell to me for a 4.5 cap and the market's a 5, that's very valuable. So it depends a lot on what the business plan is and what we want to do. What we'll always do when we underwrite properties is we get the pricing that they're asking for. Usually there's some sort of pricing associated, and we'll underwrite and we'll figure out where can we take the property to, what do we think we can cash flow, and what do we think we can sell it for, and then we back into our offer to hit the returns we need. And if the pricing matches up, fantastic, we'll offer. If we're under, we'll either not offer or we'll just offer what we think it's worth. So oftentimes we don't just say, hey, we buy 5.5 cap deals in these 5 markets that are value add. We're more concerned about the story and what we can do with the property and where we can take it, and we'll back into our offer. So a lot of times they're close, but a lot of times we end up coming in underneath. I don't think we've ever come in overpriced on what somebody is asking for. I don't think that's ever happened. So, the deals we come in right what they're asking for, we offer and we usually win. So, the deals we're buying right now in Columbus and Jacksonville and the deals we bought in Jacksonville prior to, they were all deals we underwrote. We backed into the returns and where we thought we could take it, and we offered what we thought it was worth. So we're a little bit less concerned on what it is going in. It's obviously, as you start to know a market, and if it's, a typical run-of-the-mill, straight-up-the-fairway value add, we like to see high 5, low 6, if possible, pending market, but we're less concerned on what it is. So that's all it is. And there's other things, too. For example, if you're buying a deal and taxes are going to quadruple, it doesn't matter what the cap rate going in is. It matters what the cap rate is with the taxes adjusted. Same thing for their taxes could be crazy high. They could be double what you can operate the property at. So if you buy it for a 4 cap, if you're buying it on adjusted expenses, it could be a 6.5 cap. So cap rates are kind of subjective. I would not get too hung up on them. They're good to know and good to understand, but there's a million different ways you can kind of state cap rates, and we're just less concerned. That's all. Last question of the episode. Oh. Or was that the last question? Was that 4 questions? 10, 20% down. 6 into 1. Oh, bad idea. 6 into 1. Cap rate. Yeah, that was 4. Shit, we're done. Awesome. So that's it for this week. It is Friday. I'm going to go home. I'm going to have a couple drinks, relax. Got some plans for tomorrow. Otherwise, I'm just going to relax, regroup for next week. Going to plan out some content for you guys. Other than that, that's it for me. If you did like this video, please go ahead and like it. If you would like a question in a future episode, drop it in the comments below. Shoot me a DM on Instagram. What else? Subscribe to the channel. Podcast coming out very soon. We are editing it right now as we speak. The editing is being done, I think, October 1st. Don't put in your calendars yet, but I think it's coming. October 1st, I think, is going to be the drop date. Audio and video. So I'm going to link it in my channel, the Real Estate Investing Experience YouTube channel. They will be dropped there. There will be video versions. The first couple are not as good as the last few that we've done. So the first 2, 3, 4, not as great as the last 4 that we've done. We found our feet. So give us a couple weeks. It will get better. But I'm pumped. I'm happy it's coming out. I'm really excited. So make sure you go subscribe and like that. Otherwise, that's it. Thanks for watching. Have a great weekend. See ya. Mic drop.